Good afternoon, everyone, and welcome to Prestige Wealth Management Group's second quarter 2022 economic and financial markets update. On the call today, you are going to hear from Prestige Wealth Management Group's CEO, Roy Williams, Wealth Advisor, John D'Angelo, and Senior Portfolio Manager, Paul Esposito. On the agenda for today, we're going to be talking about the state of the economy, inflation and the Fed, fixed income markets, equity valuations, and the importance of staying invested, and then we're going to finish up with a Q&A. Just a quick reminder before we get into it that the meeting is being recorded, so you will receive a replay of today's meeting, and we cannot answer any live questions on the webcast today, but if you do have any questions, please send in an email to us at pwm@prestigewmg.com, and we'll be sure to get back to you. And with that, I'm going to pass it over to Roy.
Welcome, everybody.
Thank you, Michael. All right. Well, I think what Michael meant to say was Paul. I just want to start off with citing that the second quarter was indeed a very challenging environment for investors. Persistent inflationary pressures, supply chain issues, most notably due to China's shutdown, the war in Ukraine, and the Fed's rate hikes predominantly contributed to the fear of slowing growth and a recession for the quarter. Although many of the economic data points have begun to confirm what we could deem to be a technical recession, usually in the eyes of most economists, which is two back-to-back negative quarters of GDP growth, there's still a lot of conflicting data that's categorizing the economic slowdown more along the lines of what could be seen as an earnings recession, or a mid-cycle slowdown as opposed to a full-scale recession. And even if we do, in fact, this month, and GDP figures will be coming out next week, and if the Fed, or if the Bureau of Labor and Statistics, rather, prints a second negative quarter, we, will be in a technical recession. But I do think it's going to be more on the mild, front, just because of, again, a lot of the conflicting data, which we're going to go through in a minute. Nonetheless, for the quarter, equity markets officially entered a bear market. We experienced a decline for the year of greater than 20% on June 13th for the quarter. And again, the markets, in our opinion, have already heavily discounted the odds of an economic slowdown. The bonds, on the other hand, bond market has uncharacteristically also declined in the wake of growth concerns. Traditionally, if there is a slowdown on the horizon, usually tend to see bonds be that ballast, but the pressure that the Fed has been putting on the interest rate market has, really been the key driver behind the negative returns there. When looking at GDP growth for the quarter, since that data, the confirming data comes out in April, we officially contracted in terms of GDP growth in the U.S. For the first quarter by a figure of 1.6%. Certainly adds up when you factor in the inflationary pressures that's eating away at a lot of the discretionary spending, higher energy costs, higher food costs. When you see, that accounts for almost 70% of our GDP comes from consumption, there's no wonder why, we've seen a contraction in our GDP. But if we focus on the current quarter, and again, we won't know until next week when the Bureau of Labor and Statistics provides us with that reading. At present, the Atlanta Fed has a nice little function called GDP Now, which essentially takes in all of the same figures and statistics that the Bureau of Labor and Statistics does for its GDP number to give us a real-time reading. And it is at odds with what a lot of the major consensus is still calling for, a slight increase, of about 2.5% GDP growth for Q2, whereas the Atlanta Fed's closer to a contraction of 1.5%. Now, it could very likely be that we see a flat number. But again, given the high readings in inflation, especially the commodity spike that we saw right at the beginning of June, I would venture to say that we more than likely will see that official GDP number come in closer to what the Atlanta Fed has projected as of late. And looking at global economic activity, it certainly confirms that we are seeing a slowdown in growth. So this pretty chart is the Purchasing Managers Index for both manufacturing and services. If you look at the top, we factor in all global economies. From May to June, you could see readings still staying slightly above 50. Just for your information, a PMI reading that's 50 or higher shows signs of expansion. Anything lower than 50 shows contraction. But by and large, if you look at all the developed market economies, namely Europe, you can see from May to June some pretty sharp declines. But again, a lot of these figures were starting to worsen post the incursion in the Ukraine. And for Europe, obviously the energy cost pressures that they've experienced has certainly put a bigger slowdown at hand in their PMI readings. Looking at the emerging markets, China clearly in a contraction, and that has much to do with the zero COVID policy and the lockdowns that ensued in the second quarter. Of course, the housing issues and lending issues that continue to persist there aren't helping matters out. Russia as well, due to the sanctions, is clearly in contractionary territory. But again, the mode of growth from a developed market standpoint, from a U.S. standpoint, at this point is still expansionary, but it is slowing. And that, of course, is the risk as we head into the third quarter. If inflation doesn't, in fact, start to dissipate, we very well could also be joining, a contractionary reading as well. But, if we switch back to the consumer, the resilience of the consumer, I think it's important to note that when you look at household balance sheets, they still, are at very reasonable levels. We're not seeing the level of excess and leverage that we saw, during or prior to the financial crisis or prior to any other major recessionary downturns. The top chart here shows household debt payments as a percentage of disposable income. As you can see, at the end of the second quarter, we sit at about 9.5%. And this is still well below the pre-pandemic levels, certainly well below what we saw in 2007. And of course, even in the 80s with the hyperinflationary environment. Again, I think this really puts into perspective the consumer's capacity to spend. Although on the other hand, that capacity to spend has certainly been stymied by personal savings rates. So if you look at the chart below, we do see, as the pandemic ensued, 2020 into 2021, all the stimulus payments, your average consumer was certainly flush with cash, and that's what propagated a lot of consumption. Heading into 22, with the inflationary pressures, we actually see the savings rate going negative, which again is certainly hindering the consumer's ability to spend on those discretionary items. So, this development could really be viewed as a sort of a glass is half full scenario, because when you factor in the state of the employment in the United States, and I'll let Roy take this, it certainly paints a different picture.
Yeah, when you look at unemployment, if we look at the past couple of recessions, there were huge spikes in unemployment. And, right now, I saw a number projected maybe for June, we hit 3.9% unemployment rate. So historically, unemployment is still very solid. And also, when you look at the statistic, there are 2 jobs available for every unemployed worker. So the employment market is doing well, and people are, we've had clients get some great jobs recently. So we'll have to see how this plays out in terms of we are seeing some slowdowns. I was on the phone with a client from South Carolina yesterday, and South Carolina required everybody to go back into the office. And he said he heard a number such as 20% of the people decided to leave employment because they didn't want to go back into the office. So you're going to hear some of that happening in the marketplace. But in spite of the unemployment numbers, we're seeing wage growth also, moving up, and it's expected to be about 4% this year. Now, when we're looking at real estate, real estate has been amazing, right? Post-COVID, we had a market that I remember working with an attorney that they needed help to sell a home. And I ran numbers for a town such as Summit or Milburn as to what the average inventory is, what the current inventory is. And it was amazing. Once COVID hit, within a year, there was no inventory. And that will help us through the real estate. Normally, when we do have a recession, as Paul said, we do expect this to be a mild recession because, as what I discussed, with employment being solid still and the real estate market being still in good shape. You've had inventories increase, but they're still significantly below average numbers. When mortgage rates, I guess they dipped below 5, or they were above. They were at almost 6. Still, I remember buying my first house when interest rates were at 12%, and I was happy when I closed. It was new construction in Howell, New Jersey, and I was so happy that I got 10 5/8. So these rates, even though it's challenging, there's still historically decent rates, and we're not seeing a big dip in home prices yet. I think you're going to have inventories increase, and you may have some tightness in the market because, let's face it, in New Jersey, historically, we weren't getting 10, 15 bids on a house. I remember a client a few months ago telling me they were trying to buy a house in Tewksbury, and another client was trying to buy a house in Clinton, New Jersey. And, they had to come in with the greatest bid, and it went significantly higher than the asking price, to a tune of probably close to $50,000 in each case. And what's going to really help us, if there is a housing slowdown, is not having subprime mortgages. As you can see by the bottom right hand chart, majority of the mortgages are 760 or above credit score. So people are going to continue paying their mortgages, even with an economic slowdown. So my prediction is real estate may slow down, but it will still hold up because of the below average inventories that we do have out there. We are seeing a slowdown with new homes in that sector because of the amount of inflation that they've experienced in terms of, in building a new house. So a lot of the new construction, we've seen exponential increases in the prices. And before we went on this call, I was saying that we're seeing and hearing from clients that some of the builders are running specials now, starting to run specials, because let's face it, their cost of construction is coming back down. Wood was up to $1,400. Now it's down to, today was at $620. And, John in a minute is going to talk about commodity prices. But as the supply chain hopefully gets solved soon and the other commodity prices come down, we'll be in better shape for the home builders. And John's
Right,
going
so I get the distinct pleasure to talk about the elephant in the room, which is the inflation situation. It's been a primary driver of the volatility that we've seen in asset prices this year. When I look at inflation and I think about the causes, there's two real, I think, focal points that you need to look at. One are the supply chain issues that we've talked about briefly, and then the other is the spike that we've seen in energy costs. And I think from an energy perspective, if you take a peek at the chart, 34% growth in energy costs as of May of 2022. It's a primary driver of the 9.1%. I mean, in the chart it's 8.5. The last inflation number that we had this month was 9.1%, which may very well be a peak number, and we'll talk a little bit about that, but energy's been a massive driver of it. I think this probably started some time ago, at the beginning of the pandemic. We saw a production shift to more of an OPEC plus price-controlled production shift. And then at the same time, we had this reopening of the economy. We had a whole lot of pent-up demand when it came to travel. So everybody was stuck in their houses for months, and people were dying to get out and go on vacation. And as things opened up, we had this massive pent-up demand. And then, then we had the Ukrainian war, and I think the Ukrainian war just really amplified the situation greatly, and that caused energy prices to spike significantly, which were already high. What's maybe a little bit less known, about the Ukrainian war, or less talked about, is that Russia is the top producer of wheat in the world. Ukraine is actually the 5th biggest producer of wheat in the world. 1/3 of the exports of wheat in world exports come from the combination of Russia and Ukraine. So if you look also at the what I would call the other big driver of inflation is, food prices being up 10%. That certainly has been a contributor to this inflation problem that has persisted and has not been transitory, as the Federal Reserve initially had indicated, and the United States Treasury as well. But let's take a peek at commodities. And what we've seen recently is we've seen a massive decline, I guess, at least a sharp decline in general commodity prices. I'd say month over month, talking, from a peak of maybe in late June until now. Some of that is probably attributed to what we would consider this anticipated potential economic slowdown. So, as the Federal Reserve raised rates, and they've continued to raise rates and indicated that they're also going to raise rates even higher, and we'll talk a little bit about that in a few minutes. We've seen a sharp decline in crude oil, natural gas, energy in general, grains, industrial metals. If you look at it across the board, we've seen this fall in commodities prices. Now, this may not be something that we'll see in the CPI number tomorrow or next week. It's going to take some time to move into the system, but it is a positive note, from the standpoint of potentially over the next quarter or two, seeing some of these inflationary pressures come down. And with that, I'm going to turn it back over to Roy to talk a little bit about those interest rates.
Yeah, with the Fed, I was around, Michael and I were at a meeting recently, and they asked people to raise their hand if they have been around for the last 5 recessions, and I was one of, I think, 5 or 6 people that were able to raise their hand. And what's, different about this in terms of the Fed is going to, without question, next week raise rates. Most likely, we're expecting 75 basis points, 0.75%, and possibly another 1 or 2 increases of 50 basis points before year end. But when you look at this chart, if you look at the expected as we go into 23, 24, it's expected that the Fed is going to start decreasing rates. And the reason for that is the economic slowdown, and also at some point commodity prices will start decrease. I mean, they've decreased, as John said, significantly already, but it hasn't gone to the end user yet in terms of, we've seen gas prices come down 50 cents at the pump, but our food prices haven't dropped yet. We've seen wood prices drop if you go to Home Depot, but again, not all commodities really have the price reductions. Food prices really haven't dropped at all, come to the end consumer. So, we'll have to see what happens as the year goes on, but hopefully the Fed is forward looking a little bit, and we'll take a look at that. Most commodity prices have dropped from their high between 20 and 50%, and that is significant. But again, the Fed is always backwards looking, and the numbers that will come out in the next quarter will still be, inflation numbers will still be high. The good news with interest rates is that now on the bond side, we're going to get paid some sort of yield. Before on bonds, the yields, as you can see by the chart, were next to nothing, especially on the short end of the curve. When you look at this chart, you'll see a flattening yield curve. You'll see the 30-year at 3.14 and the 7-year at 3.04. So, very flat yield curve. And we'll have to see what happens with the increase next week if it inverts further with the 75 basis point hike on the short end. So we'll have to see how that plays out. But we do see interest rates, like I said, the Fed slowing down at some point as we go through the year and into next year. And in fact, maybe a decreasing interest rate environment we'll get into. With that, I'm going to hand it back to John to talk about valuations.
Yeah, this is this chart here. Interestingly enough, one of the things that we've seen over the course of the years, we've seen equity valuations fall precipitously, and that comes from a combination of the increased inflation, the significant and very quick rise in interest rates that we've had that leads to a higher discount rate, get increased borrowing costs, and therefore it's pretty simple when you look at when you think about a price to earnings chart. If earnings are going to come down based on those factors, price goes along down with it. We've seen an erosion of earnings power, but we're closing in on what I would think would be trough valuations. We might not be quite there yet. We're around 15, 16 times earnings. Maybe trough valuations might be around 13 times earnings, but we're close. And we're certainly not, stocks are certainly not expensive, which they might have been considered more expensive, depending upon the metrics that you're looking at back in, 2019 and parts of 2020. So, let's talk a little bit about earnings and earnings growth. This chart's an interesting chart. One of the things I would point to is what we've seen is this massive margin compression, and that makes perfect sense in the environment that we're in. So corporations have been trying to absorb inflation, and they've been trying to resist raising prices, even though, of course, prices have went up as well. But margins have went down quite a bit because of these input costs that are higher. They're coming from the supply chain disruptions. I don't know, I talk all the time about, going out and different products you can't find on the shelf, certain things that you try to get, you can't order. And these are, at the crux of some of the problems that we have that we still need to solve on the back end of this reopening economy. But the positive aspect of this is that we might have hit, peak compression points. We might be at the bottom end of margin as these input costs and as some of these commodity prices that we've seen fall, they continue to fall. That's going to take more pressure off of these higher input costs, and they're going to allow corporations in order to recoup some of the margins. Now, granted, I mean, if you think about that 70% margin number, that is really I would attribute that to a COVID world. I don't think margins are gonna return to those levels, but they should normalize. With that, I think I'm gonna turn this back over to Roy to talk a little bit about consumer confidence.
Consumer confidence, right now is really almost at an all-time low. With the negative news in the media about inflation, at the pump, everybody's feeling it. People on fixed incomes, it could be seniors or people who are on disability, they're hurting right now because their income's in no way keeping up with the real cost of inflation. So when we're at a trough, in terms of the bottom, it's normally, if we look at previous troughs when sentiment went down 11, these are opportunities in most cases. If we look at November, they're actually buying opportunities from the equity market standpoint. It's counterintuitive, but when things feel worse, it's probably an opportunity to buy. When we look at the S&P 500, the last 8 sentiment bottoms, it's been almost a 25% return, following it. So although the, market environment looks bleak and the economy looks bleak, it's an opportunity as we go forward. Now let's look at some financial planning considerations, with the volatility that we've had in the markets and the commodity prices raising and the lack of cars. I know a couple people who recently got cars that they waited 6 months for or more. So if you have an auto lease, look at possibly buying your car, because it's a lot less. Even if you want to sell the car, buy the car off the lease and sell it on your own, and you'll make money in this environment, because we still have a shortage of cars because of the chip situation. So you want to make sure that you just don't hand the car back to a dealership. You may have significant value of $10,000 to $15,000 sitting there, an opportunity for yourself. Or you may like your car and just buy the car and continue owning it, as a lot of clients have done, recently. Because when you go to buy a new car, we're all expecting discounts, and when they're adding $5,000 to $10,000 to the sticker price to sell you a new car, you step back for a second. So look at those opportunities as leases, and just don't hand your car back in. Home projects are interesting. We're seeing, clients and friends, in the middle of home projects, and they can't get refrigerators, they can't get ovens, they ordered them 6 months to a year ago and they didn't come in, and now they're having issues because of it. And the cost of home projects has gone up exponentially. I'm not saying that contractors are taking advantage of individuals, but let's face it, when we have an environment like we've had, in terms of so many people doing home projects, they have so much work, they just put numbers out there. So make sure, if you're going to do a home project, that you get multiple quotes. And if you can, with commodity prices such as copper coming down and wood coming down, you may want to wait 6 months for these builders to slow down a little bit, so you can get your projects done at a more reasonable price, or you can get more work done that needs to be done. Obviously, if you need roof work or major work done in the house, you have no choice but to pay for the work. But if you look at just, if you need a crane to put an air conditioner in, or if you need any type of heavy equipment to do a job, the cost has gone up exponentially, even for your contractor to lease this equipment. So, you may want to consider deferral. Also, if you're looking to put a very large addition on your home, you may want to look at possibly looking at a new house. We see with the cost of additions that have gone up exponentially, it may be a situation that you're better off just moving at that point and buying a new house, and you'll save a significant amount of money. With that, I want to thank everybody for their time, and I want to answer the question that had come in. And the question is, based upon the last 2 quarters, losses in equity index funds have been disproportionately high due to being overweight in large cap tech. Will brain dead equity funds like VO make sense for the next 5 years? As we go through this economic cycle, if we look at the top 10 holdings in the S&P 500, believe it or not, only 3 of them are tech companies. Only 3 of them are tech companies. You have Apple, Microsoft, and NVIDIA. Alphabet's no longer considered a tech company, nor Meta, because they added the communications sector. And you have One Healthcare, and you have Berkshire Hathaway is considered a financial company. So yeah, large cap will make sense of the next 5 years once we get through this volatility. And as John said, this can turn around on a dime, be it President Xi from China, at least publicly is trying to put pressure on Russia to end the situation. Because if we go into a deeper recession, it hurts China. China is already in a recession, and a deep recession, and a financial, semi-financial crisis with their banking system. They don't need the rest of the world to go into a deep recession. As the #1 manufacturing country in the world, it'll hurt them further. So again, thank you for your question. And we look forward to hopefully seeing everybody in the fall as everything opens up and we have a client events again. So with that, I want to hand it over to Michael to close it out.
Yep. Once again, we just want to thank everyone for joining us today. And as a reminder, you will receive a replay of today's webcast. And if we didn't answer any questions that you did have and you wanted to send in something for us to answer, please email us at pwm@prestigewmg.com, and we'll be sure to get back to you. Thank you very much, everyone.